You're tuned into House Lux Estate, your go-to channel for all things finance and investment. We're here to guide you on your journey towards financial independence by offering insights into diverse investment opportunities and smart financial decisions. We believe in empowering you with knowledge so you can make your money work for you. From real estate to stocks, we cover it all. So let's dive right in. In today's guide, we're going to break down the process of investing in stocks into easy, manageable steps. To begin with, we need to understand what stocks are. Consider a corporation as a massive cake. Stocks, then, are slices of this cake, representing ownership in the company. When you buy a stock, you're purchasing a piece of the business and becoming a shareholder. This gives you a claim on part of the company's assets and earnings. Stocks are a popular investment choice for several reasons. Firstly, they offer the potential for significant returns. Over the long haul, no other type of common investment performs better than stocks. They allow your money to grow, potentially making you a part owner of a prosperous business. However, it's not all rosy in the world of stocks. They also come with their fair share of risks. The stock market fluctuates, sometimes quite dramatically. Prices of stocks rise and fall based on supply and demand, which is influenced by factors such as economic indicators, company earnings, and overall market sentiment. In essence, when you invest in stocks, you're betting on the future success of the company. If the company does well, so do you. But if the company struggles, your stocks may lose value. The key to successful investing is understanding these dynamics and making informed decisions based on careful analysis and consideration of risk versus reward. Now that we have a basic understanding of stocks, we can delve into the process of investing. Investing in stocks isn't a process you jump into without preparation. It's a journey that requires thorough research, a deep understanding of the market, and a thoughtful selection of the right stocks. So, how exactly do you kickstart this journey? First things first, you need to understand that investment isn't a gamble. It's a strategic game. Your research is your map, and your understanding of the market is your compass. Before you invest a single dime, spend time studying the market, understanding its trends, and learning about different companies and sectors. The more you know, the better your chances of making wise investment decisions. Once you've done your homework, the next step is to choose the right stocks. Here, it's essential to look beyond the hype. Don't be swayed by buzzwords or trending stocks. Instead, focus on companies with a solid track record, healthy financials, and a robust business model. Look for companies that are leaders in their sectors and that have a clear, sustainable competitive advantage. Now, let's talk about brokerage accounts. To buy stocks, you'll need to open a brokerage account. A broker acts as a middleman between you and the stock market. They execute your trades, provide research tools, and often offer educational resources. When choosing a broker, consider factors like fees, customer service, and the platform's ease of use. Remember, the broker you choose can significantly impact your investing experience. So, take your time to compare different brokers and pick one that aligns with your needs and investment goals. It's also worth mentioning that many brokers offer practice accounts where you can trade with virtual money. These can be a great way to gain experience and test your strategies without risking real money. Once you're well prepared and have a brokerage account, you're ready to start buying stocks. But remember, investing is not a sprint, it's a marathon. Patience, persistence, and a keen eye for opportunity are your best allies on this journey. There are several strategies you can employ when investing in stocks. First off, let's talk about long-term investing. This method is often favored by the patient investor, the one who isn't swayed by short-term market fluctuations. The goal here is to buy stocks in companies that you believe have a strong future and hold onto these stocks for years, even decades. The advantage of this strategy is that it allows you to ride out market downturns and potentially reap the benefits of compound interest over time. However, it requires patience and a keen eye for companies that will stand the test of time. Next, we have short-term trading. This strategy is all about timing the market. You buy stocks when prices are low and sell when prices are high, often within a matter of days or weeks. This strategy can be exciting and potentially profitable, but it carries a higher risk. You need to be constantly monitoring the market and making quick decisions, which can be stressful. Then there's dividend investing. Some companies distribute a portion of their earnings back to shareholders in the form of dividends. By investing in these companies, you can earn a steady income stream in addition to any potential capital gains. This strategy can be a good option if you're looking for regular income from your investments. The downside is that not all companies pay dividends, and those that do can choose to reduce or eliminate them at any time. So how do you choose the right strategy for you? Well, it depends on your financial goals, your risk tolerance, and your investing style. If you're saving for retirement and you're comfortable with a bit of risk, long-term investing might be a good fit. If you enjoy the thrill of the market and have time to dedicate to it, short-term trading could be your game. And if you're looking for a steady income from your investments, consider dividend investing. Remember, the key to successful investing is a well-thought-out strategy. So, take some time to reflect on your goals and preferences, and choose a strategy that aligns with them. After all, the best investment strategy is the one that works for you. Investing in stocks can be rewarding, but it's not without its risks. You've probably heard this phrase more times than you can count, but let's delve into what it truly means. Investing in stocks is a bit like sailing in uncharted waters. The potential for discovery and wealth is vast, but so are the uncertainties. Stocks can fluctuate wildly, and sometimes companies can even go bankrupt, leading to a complete loss of investment. However, the potential rewards are equally significant. Stocks have historically provided higher returns than other investments, and the opportunity to own a piece of a thriving company can be immensely gratifying. So how can you navigate these choppy waters? The answer lies in two key concepts: diversification and patience. Think of diversification as your lifeboat. Instead of putting all your eggs in one basket, or in this case, all your money in one stock, diversification spreads your investments across different types of stocks. This strategy reduces the risk of losing everything if one company doesn't perform well. It's like having a fleet of ships. If one sinks, the others can still sail on. Next, let's talk about patience. Investing in stocks isn't a get-rich-quick scheme. It's a marathon, not a sprint. The stock market has its ups and downs, but over the long term, it has a track record of steady growth. Panic selling during a market downturn often leads to losses, while patience can lead to significant gains over time. Remember, every investor, from the novice to the seasoned pro, experiences moments of doubt and apprehension. But don't let fear deter you. Instead, arm yourself with knowledge, create a diversified portfolio, and practice patience. Investing in stocks isn't a gamble when done thoughtfully and strategically. It's a calculated risk with the potential for significant rewards. And it's these rewards that have helped countless investors build wealth over time. With a balanced portfolio and patience, you can navigate the risks and reap the rewards of stock investing. So, let's recap what we've covered today. We've embarked on a fascinating journey, exploring the world of stocks and investments. We started off by understanding what stocks are. They represent ownership in a company and constitute a claim on part of the company's assets and earnings. Investing in stocks means buying a piece of a company with the expectation that it will grow over time. Next, we delved into how to start investing. We emphasized the importance of research, understanding the market, and the necessity of a clear financial plan. We also stressed that starting to invest doesn't require a mountain of capital. Even with a modest amount, you can start your journey towards financial growth. We then moved on to discuss various strategies for investing. We talked about the value of diversification, the benefits of long-term investing versus short-term trading, and the importance of consistent investing, a concept often referred to as dollar-cost averaging. We also highlighted the significance of reinvesting dividends, a powerful tool that can speed up the process of wealth accumulation. Finally, we addressed the risks and rewards of investing in stocks. We underscored the fact that while investing in the stock market has the potential for high returns, it also comes with risks. It's crucial to manage these risks effectively by diversifying your portfolio, setting realistic expectations, and being patient. The journey to becoming a millionaire through stock investing is one filled with learning, patience, and strategic decision-making. It requires a keen understanding of the market, a well-thought-out investment plan, and the ability to manage risks and rewards effectively. Remember, becoming a millionaire through stock investing isn't a sprint, it's a marathon. Thanks for watching House Lux Estate. Don't forget to subscribe for more valuable investment insights.